Stock market valuations have not been this high since 2001. Does that freak you out? Freaks me out a little bit. I'm going to tell you what to do about it. This is your next Wise Step video for today. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Thanks for joining me today. If you're new to the channel, hit that subscribe button, turn on notifications, and smash that thumbs up button. All throughout YouTube, you can find videos about the market's going to crash, this bubble's going to burst. But guys, and I'm not fanning that flame, but valuations are outrageous. The stock market has advanced, I believe it's 5 out of the last 6 days or something like that. But if you look over the past month, it's just absolutely surged. And yet the outlook from companies continues to be pretty bleak. And so that got me thinking, well, what do valuations look like? Let me first tell you why that matters. So if I were to tell you, well, the cost of this product is X dollars, you're probably curious, well, what do I get for that amount of money? For that cost, what do I get? Well, the same is true on the stock market. For the price of, let's say, Zoom, how much, the company Zoom, how much earnings, how much do I get? How much profit is there? For the price of Disney stock, how much profit is there? For the price of Amazon stock, how much profit is there? And of course, it's more complicated than that because it's not just today's profit or yesterday's profit for that matter. It is expected future profit. Because if I'm going to buy Disney today based on their profit today, then the price should be worth nothing. But it's expected future profit. So that makes it more confusing. But it's a measure of whether the stock market is high or low. If basically prices are too high or just right or too low. They call this the price to earnings ratio. You might be familiar with it as the PE ratio. Well, there's two ways to think about it. Well, what's the price to previous earnings, so the earnings that were just reported, but also what's the price compared to projected earnings or expected earnings? Here's what's going to absolutely freak you out. The stock market never even got cheap. You know that crash that seems like a distant memory or maybe a nightmare? That was just 2 months ago. Even at that point, stocks never even got cheap. I'm going to explain and show you one more chart that illustrates this, but I can tell you because the price compared to past earnings, so the PE ratio, is still unusually high, significantly higher than its long-term average, okay? But today's price compared to expected earnings hasn't been this high since early 2001. Oh, do you not remember that time in the stock market? It's called the tech bubble. It's called the tech bubble. That's when there was irrational exuberance. Prices were so high, they were disconnected from reality. The stock market prices have not been this high compared to future earnings since the tech bubble. Now, how could that be? Did we not learn our lesson from the tech bubble? Well, back then in the tech bubble, they said, well, earnings don't matter. The internet's the wave of the future, so today's earnings really don't matter. These companies, they're going to be fine, and they will be the future. They'll have earnings at some point way down the road. We don't care about that right now. The price is the price is the price, and it kept getting bid up. We're seeing a little bit of that now. Because of the health pandemic, maybe they're right. Well, the expected earnings over the next 12 months really don't matter because in the future everything's going to be fine. I don't know. I feel like that was pretty similar to what we heard in 2001, and the problem still persists that we don't know the future. We don't know. Here's another way to assess whether the market is high or low, and it's sort of been coined the Buffett indicator because way back in 2001, Warren Buffett said this is the single greatest indicator of whether the market is high or low. I'm paraphrasing there, but single greatest indicator of the current valuation of the stock market, and that is the stock market total value relative to GDP. Okay? Once again, I'm showing you that chart. It's at levels that can only be compared to 2001, the 2001 time frame, the tech bubble. And as you'll note on that chart, it didn't even get cheap 2 months ago when the market was at its low point. It didn't even get cheap. The stock market's expensive. It's been expensive and rising for the past couple of years, and even with that huge downturn we saw in March, it never even got cheap. What should you do about this? Take caution. I didn't say take cover, I said take caution. Be very cautious about jumping into this FOMO stock market rally with new dollars that really should be low risk. Okay? I am a big believer in the stock market long term. You're going to own the world's greatest enterprises and participate in their appreciation over the long term. What a wonderful opportunity. We should all own stocks for the long term. I'm not saying get out of stocks in the short term. I'm saying make sure you don't have any short-term money in stocks. And I'm also saying if you're hoping to retire soon or you're looking at retirement just a little ways down the line, make sure you're taking the right level of risk. That actually applies to you if you're in your 20s or 30s. If you've been scared by this thing because you just started investing, you saw the big chaos that happened in the beginning part of the year and you got conservative, no, take the right level of risk. And if that right level of risk is more aggressive, just prepare for some volatility. Will we see some? We might not, guys. There is apparently $1 trillion sitting on the sidelines waiting for the stock market to get cheap. If this stock market continues to rise, as that money comes into the market, they could continue to bid prices up. Federal Reserve Chairman Alan Greenspan said that the stock market was irrationally exuberant 4 years before it hit a top. 4 years before it hit a top. The stock market can remain irrational for far longer than you can make bets against it. So this stock market might continue to rally. I'm just saying it's reaching threatening, expensive levels. So make sure you're working with your certified financial planner to take the right level of risk. You keep hearing me say it, I also would very much recommend a momentum strategy. We call ours dynamic. It has been pivoting quite a bit and is now fully back in the market and fully into growth stocks. We'll see if that rotates here, but it's been positive. It got out of stocks, was basically out of stocks all of March and most of April, and it's back fully in. But make sure you've got a piece like that in your portfolio so that you can manage any future volatility. You need to talk to a CFP, maybe need a second opinion on your investment strategy and approach. You can always reach out to us at Korhorn Financial Group. Find us online, korhorn.com, that's Korhorn with a K, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.